I'd like to welcome everybody to the August 2023 late summer edition of the Idaho Department of Labor's Labor Market Insight Series. Little webinar we have going as far as our team and providing some insight in terms of the Idaho's economy and different kind of interesting points that our team of economists around the state research and provide this little service to you guys. So my name is Craig Shaw, and I'm the Labor Market Information Research Supervisor at the department and your host for today's webinar. This month, Sam Wolkenhauer, our labor economist from the Northern region out of Post Falls office, is giving a presentation on Idaho's economic resiliency, and will take us on an exploration of Idaho's economic data and examine how and why the state's economy has proven to be so durable despite recession fears that have been circulating for the past couple of years. So this is a change in the topic of manufacturing globalization that Sam was, we told you Sam was going to present when we signed off last month. We apologize for the sudden change and to anyone that originally signed up for that topic. However, we're really confident that you will find Sam's topic today to be enlightening and to say the least entertaining. And as we give this the time to you, Sam, perhaps you can first tell us what drew you to this topic.
Yeah, so the sort of motivating animus for this topic is rooted in the work we're doing preparing Idaho's annual LMI report, which is a long document that we prepare that examines all the economic indicators in the state of Idaho. And what I was noticing as I was preparing this is that as I was going through a section on income in Idaho, 2022 was probably the single strongest year of income growth in the state of Idaho that we've ever recorded. Every measure of income, whether you're looking at hourly wages, median household income, et cetera, they all jumped significantly. The poverty rate declined. And actually, not only did Idaho's income jump significantly, but we significantly narrowed the gap with national income measurements. Traditionally, Idaho has been one of the lower income states, lower cost of living state, et cetera. And the gap actually narrowed significantly. And so what I was sort of thinking about as I was looking at this is how strange it is that at the beginning of the year, we were hearing constantly from a lot of different sort of quarters, as I'm going to show you in a moment, that there were a lot of concerns that the economy was going to tip into a recession. Okay, so the economic mood around the beginning of the year was very, very pessimistic. And yet, when we look back at the data, what we see is that the past year was an exceptional year of income and job growth for Idaho. So the juxtaposition of these two facts is sort of the premise here that we're going to explore. So with that, we're kind of going to just jump right in here. And what I want to do is take us back about 6 months to Q1 of this year and remember what the discussion was like about the state of the economy. So I want to show you some headlines from Q1 of this year and just kind of remember what were people talking about, what were the major strands of thought in the economy. So let's just look at a few headlines from the start of the year, just so we kind of have this baseline. Okay. Silicon Valley bank failure raises fear of financial contagion. Right, so we know that we had some of the largest bank failures since the 2007 financial crisis. We had literal bank runs in the sense of people rushing to try to get their money out of these banks. The trading of regional bank stocks were halted, and there was this sort of looming fear that we were plunging into another financial crisis. Okay, so that was really obviously not a good thing and raised a lot of fears about the state of the economy and the state of financial markets. We had JP Morgan, one of the largest banks in the world, which certainly employs a competent and robust team of in-house economists, saying that a recession was probably on the way, and they even used this phrase, already past the point of no return. Okay, so they're obviously smart, competent economists, and for them to say something like that does not really do a whole lot to raise our confidence in the state of the economy. We had a wave of tech layoffs with major companies, Twitter, Facebook Meta, Google, Alphabet, Microsoft, Apple, right? Major layoffs, and we had this this sort of flashing alarm bell that layoffs were beginning to rise. So not only do we have banks failing, we have economists warning that there's a recession coming, but maybe we're even starting to see it in the labor market with layoffs. And then finally, we had sort of the definitive authorities, the Federal Reserve, the staff economists at the Fed, at the central bank, essentially predicting that we were headed for a recession and that banking crisis was kind of going to be the first domino. Okay, so this is where we were earlier in the year. This is without a doubt a explicitly pessimistic sort of scenario. You've got warning signs flashing on all sides. Layoffs in the labor market, bank failures in the financial sector. You have economists both in the banking sector and in the government sector saying that a recession is probably likely. So for obvious reasons, a lot of people probably took this at face value. I was certainly one of them and said, you know what, this maybe isn't a super stable situation that we're in. And yet, here we are, many months later, we've gone through 2 subsequent quarters, and we look at all the data, we're kind of looking, we were promised a recession, right? And we're looking around for it, and we kind of go, where is it? So here is GDP growth, right? So this is growth in the economy, and this is adjusted for inflation. Black bars are the United States, blue bars are Idaho, and the last 4 quarters have been really solid, really strong. So we continue to have robust GDP growth on the national side. We're still waiting on the Q2 data for Idaho, but Idaho's GDP growth has been stronger than the national growth rate for 8 out of the last 10 quarters. So it was kind of wobbly, right? You can see how it's a little volatile there at the end of 2021. That's just as we're kind of parsing through the after effects of the pandemic. But really since then, it's been a bunch of really solid quarters strung together. Unemployment is very low, as we're going to see. Job growth continues to be high, and income growth in the state of Idaho in particular was astonishingly high in 2022. So this is kind of where we're at. We were, in a sense, a recession was very heavily advertised. There were certainly a lot of real reasons to maybe have concern about the economy. But when we look at the data, and even this is adjusted for inflation, it really looks rock solid. Okay, so this is kind of our question today is, why is everything actually pretty much okay? And this is maybe a different tone than you might be used to, because economists, no surprise, are kind of known for being a little bit of a dour bunch, right? We're not known for being the most upbeat, optimistic trade. And yet that's kind of going to be our question today. Everything really seems pretty solid. So how did everything turn out okay, despite those concerns to the contrary? And what I want to show you is that, in fact, all of those, sort of concerns that we had earlier in the year look really stable now. Okay, so let's look at some more recent headlines about those same topics. Okay, so what changed? Remember the banks? Well, here's a recent headline: U.S. banks shrug off the turmoil to ace the health checks. Right, so the Federal Reserve, the central bank, does stress tests of the banking sector. So they look at their balance sheets and they essentially kind of simulate and ask, okay, how healthy are banks? How healthy are they in their ability to respond to financial turmoil? And the latest stress test of the financial system looked really good. So the Fed is now saying, actually, we think that the banking sector is really solid right now. Remember JP Morgan, their economists were predicting a recession? Well, they've canceled that. They've raised their growth estimate, and they've actually said that they're no longer expecting a 2023 recession, and they think the economy is far more durable than they previously expected. Okay, so what about those layoffs, right? We had all those layoffs in the tech sector. How about this? Tech layoffs see former workers in high demand elsewhere. Turns out that the demand for workers in other sectors of the economy was so high that people that got laid off went back to work. They found new jobs almost instantly. So even with those layoffs, there was no spike in the level of unemployment. And finally, let's check in on the staff economists at the Fed, who were explicitly saying, yeah, probably going to be a recession this year. Fed staff dropped their recession forecast. Okay, so all of those flashing red lights that we had earlier in the year, they've all gone off and they've all switched over to green essentially. So clearly the economy was far more durable than people were expecting earlier in the year. And this is kind of what we want to work through now is, why is that? Why did everything turn out far more okay than people were expecting? And why is Idaho in particular having such a strong run of economic growth? Okay, so to kind of answer this, we need to look at two different facets of the economy. We kind of want to look at what's going on with inflation, right? Because inflation was a major driver of these concerns. Prices were rising, the central bank was having to raise interest rates, and there were kind of fears that all these different sort of rocks to the economy were eventually going to tip it over into a recession. So we're going to look at what happened with inflation, and then we want to look at the labor market, right? Because the labor market has been the major source of strength in the United States and in particular in Idaho. And so we kind of want to get a handle on that. And the overarching message here is going to be that the economy, particularly in Idaho, is really shockingly strong, given all the warnings that we received earlier in the year. So let's just jump right into this. Sort of the overarching question, the analytic framework, the million-dollar question in the economy for the last few years has been the following. Can we bring down the rate of inflation without tipping the economy into a recession? Okay, and so the phrase that you will hear if you read the Wall Street Journal or listen to what the Fed is saying is they use this phrase soft landing, right? Because they're trying to bring down the rate of inflation. And the way you do that is essentially by gently trying to press the brake on the economy, press the brake on the rate of inflation without pressing so hard that you jolt the economy into a recession. So this has been the question. Could we make a soft landing without compromising the overall health of the economy? And increasingly, it looks like that is the case. So let's talk about why that is, what's going on with inflation, and why the economy has proven so durable as we've tried to bring down the rate of inflation. Okay, so let's start with a sort of headline look at what's going on with inflation. Okay, so this is showing you what has gone on with US consumer prices over the last few years. So we kind of start the clock in 2019, right? That's our last year before COVID. And we look at what happens to the price level. Okay, so inflation, sort of in the long run, has been about 2% per year. Okay, so that's the black dotted line, just kind of showing you what would have happened if nothing had gone wrong, right? If we just kind of continued that little stable 2% rate of inflation. Then the blue line is what actually happened to US prices. And you can see that starting in early 2021, as we were trying to climb our way out of the pandemic and the recession caused by that, the rate of inflation started to exponentially tick up. So right now, prices are about 20% higher across the board than they were in 2019. And they're about 11% higher than they would have been if they had just continued at that stable 2% growth rate. Okay. So clearly this has been a pretty significant uptick in the cost of living. Now, that 20% number is the general across the board look at prices. There are some sectors, there are some types of goods where prices have grown more than that. So for example, food is up closer to 28%. Energy prices tend to be a little more volatile. But across the board, you're talking about prices being about 20% higher than they were before COVID. Okay, so that's kind of how we think about this inflation problem. And the question has been, can we stabilize this? Can we relieve this price pressure without the economy tipping over into a recession? So to answer that question and to understand what happened with inflation, we have to talk about what caused this inflation. Now, pretty obviously, just from looking at the dates, we can say that this was caused by something related to the pandemic, right? The pandemic seems to be the triggering event for this. So we have to figure out what it was that set this off. And it turns out that it's actually kind of a complicated question with a few different elements to it. So I've kind of come up with what you can call the recipe for inflation. Okay, so it's a few things going on at once. And together, these things are the cause of the high inflation. And this has been pretty well established. This is kind of how the Federal Reserve economists are talking about this, for example. So there's a few different things going on. One element of this is that we have a labor shortage. right? This has been pretty well established. We've actually talked about this in previous webinars that we have a shortage of workers, very low unemployment, and what that does is it drives wages up. And some of the cost of those wages gets passed on to the consumer in the form of higher prices. Okay, so just over the last year, wages rose by over 6%. Okay, now keep in mind that labor is the main expense in the United States economy. Almost 80% of all the cost in the US economy ultimately boils down to labor costs. Okay, so when you have an across the board wage increase of 6% on average, think about what that does to the cost baseline of the economy, and that does get passed on to the consumer in the form of higher prices. So this is one element of the inflation problem. The other problem is that the pandemic caused an enormous spike in the price of raw materials, okay? And so this is pretty easy to understand. We know that in the 21st century, raw materials are traded globally. All the different mineral and chemical inputs and components cross the ocean, bunch of different times, different cargo ships in different forms before they become end-use products. Okay, that's just the nature of the globalized trading system. And what I always like to point out is that even things that you think of as being produced locally, so for example, agricultural products, right? We think of food, we grow food in Idaho, right? But even food is not truly produced locally in the sense that farmers still require fertilizers and pesticides that are probably not made anywhere close to them. They need diesel and they need components for tractors and other machinery, right? So even food that we think of as being grown locally has a distributed supply chain of inputs that have to be shipped across the country, across oceans and national borders, okay? And when the pandemic came along, this system of trading was basically turned off, okay? So shipping was stopped, cargo containers piled up, and the price of these materials just skyrocketed. Okay, so that's the second element of this inflation problem. And this is what is referred to when you would hear the phrase supply chain problems, right? Is essentially physical inability to move goods and products around the world. And then finally, we had the liquidity issue. And this references the fact that during the pandemic, to try to stabilize people's finances, we had a bunch of different programs that increased the amount of liquidity in the economy. Okay, so we had stimulus checks. Those are kind of the most famous ones, just direct deposits into consumers' bank accounts. But we also had an expansion of the unemployment insurance system on the federal level. We had a deferment of rents, a foreclosure moratorium, student loan deferments. Okay, so what all of these programs did cooperatively is sort of boost the amount of money available to consumers. And that turns out to be really important because we have this concept in economics that we call supply and demand. It's not particularly complicated. It's taught in Intro to Microeconomics, okay? So supply and demand predicts that when the price rises, the natural reaction of the consumer is to try to buy less, right? Demand scales in response to price. But what happens when the consumer is actually sitting on a pretty big cushion of cash in the face of a price increase? Well, his ability to continue spending is increased, and it kind of made the American consumer a little bit indifferent to inflation at the start of things. Okay, so even though prices were rising, consumers continued to spend. Okay, and I'm going to show you what that looks like graphically here in a moment, but that's really important because it really gave juice to this inflation issue. Okay, so there was a really great expression that I read in the Wall Street Journal from Greg Ip, who's their sort of economic columnist, their lead economics writer, and he said that, what caused all this inflation? It wasn't necessarily the pandemic or the stimulus, it was the pandemic and the stimulus back to back, sort of this double whammy that set this whole thing off. Okay, so this is our recipe for inflation. Okay, so let's look at what's going on with these different components and kind of see how the economy is recovering from this. So let's take a look at that raw material side. So one thing that we've noticed is that there's been enormous recovery on the raw material side when it comes to prices. Okay, so this is a index that we call the producer price index. Okay, most people are familiar with the consumer price index. That's a measure of inflation. And the producer price index is very similar, except it looks at things like raw materials and labor costs. Okay, so just for example, a car, a finished automobile, would go in the consumer index. Things like sheet aluminum and rubber and the semiconductors will go in the producer price index. And you can see we had a big increase in the price of raw materials after COVID. So this ran up to well over 20% annual inflation through 2021 and 2022. But starting in June of last year, this started to come down, and it actually came down very, very quickly. And since January of this year, prices of raw materials, the growth has actually been negative. Okay, so that's the red there. So we're now going on 7 straight months of the overall price of raw materials decreasing. Another thing that you could look at is the price of shipping containers, right? How expensive is it to ship materials around the world? The price of shipping containers has been coming down for well over a calendar year at this point. Okay, so that's done a lot to bring down the rate of inflation, actually having negative price growth when it comes to raw materials. Now, it took a little while for this to kick in, right? We had to go through a couple solid years of prices of raw materials rising really quickly. Partially that is because of what is happening in Ukraine. Ukraine and Russia are major producers of raw materials. So obviously, conflict in Eastern Europe between these two countries is not particularly healthy when it comes to the price of things like fertilizer and wheat and other raw materials that are exported by these countries. So that's one reason why it took quite a while, right, for supply chains to really sort of get moving again and working the way we want them to. The other reason it took a little while is China was a little bit slower to reopen its shipping after the pandemic than other countries were. Okay? And China obviously is one of the world's most important economies when it comes to trading and manufacturing. So when China is particularly hesitant to open up after the pandemic, that causes things to be a little slower to get moving. But we're working through these problems, and we're definitely seeing strong improvement on the price side. And this is doing really wonderful things for consumers in terms of bringing down the level of inflation. Okay, let's look at another aspect. Remember, we talked about all that liquidity from the stimulus checks and the expanded unemployment insurance. So I want to look at what does that actually look like, okay? So the easiest way we can look at this is to just kind of look and say, okay, how much cash do American households have on hand, right? What's their liquid pool of assets, in other words? So this is a series that shows you net private savings, okay? Now note that is net, okay? So that is exclusive of liabilities, right? So, what's the liquid position of the American consumer on net? And you will notice, kind of obviously, some big spikes in this graph right around 2020 and 2021. Okay, so those two big spikes are literally stimulus checks hitting bank accounts. Okay, so we can see this in the consumer financial data. Right, so you have these big spikes as those stimulus checks hit bank accounts. And so the result of this is that the American consumer actually came out of COVID with an unusually enormous amount of cash on hand, okay? So I want you to note that the scale of this graph is in trillions, okay? So we're talking about coming into late 2021 with about $4 trillion in household bank accounts, okay? Now, you can see that it gets spent down, okay? It begins to deteriorate rapidly. There's two reasons for this. One is that during the pandemic, people were saving, right? People weren't really going on vacation. They were deferring major purchases because there was a lot of uncertainty about the economy. Okay, so people were saving. And then when the pandemic eases, a lot of that sort of pent up spending gets unleashed into the economy, right? It's kind of like opening the gate on a dam. You have all this pent up demand. People want to go on vacation because They didn't go on vacation for 2 years. They had purchases that they were putting off. Okay. And so as the pandemic sort of evaporates into the past, all of that spending gets released. And you can see what happens to the bank accounts when that happens. They get spent down really quickly. The other reason that they get spent down quickly is because of inflation, right? Prices are rising. So even just normal baseline expenses begin to drain savings accounts over time. Okay. Now, the net effect of this is that we have to go through a period of, an economist would probably call it unwinding the balance sheet, but you can just think of it as sort of returning to the normal level of liquidity in the economy, right? So there's kind of like a lot of money sloshing around, it's in people's bank accounts, and it kind of has to work its way out, kind of like ripples on a pond, right? And so the stimulus takes a little while to unwind into the economy. And while that happens, inflation is still fairly high. But what I want you to notice is that the savings bottom out around June 2022, and then they begin to rise again. Okay, so there's a pattern that begins to emerge. And I want to kind of point out a few things to you. Several things peaked at the same time in June of 2022. So here are some things that all peaked in 2022. Okay. The spending down of the savings accounts kind of hit its bottoming point in June. Raw material inflation began to decline in June of 2022. The overall rate of inflation began to come down in June of 2022. And finally, home prices and rents peaked in June of 2022. So when you look at the synchronization of all of these things, we start to get a really clear picture that June was kind of the point that inflation maxed out and we began to cool and stabilize the situation. And when we look at all of this data, what we see is a progressive stabilization of the economy starting in June. Okay, so let's go back to our inflation recipe. Okay, raw materials, right? They're coming down. Okay, so we can scratch that off. Consumer liquidity has reached a stable point. Okay, so we can scratch that off. Wage growth is still high. Okay, but it's starting to cool off. So we're going to leave that on the board. But the other two we can scratch off. So we would kind of expect inflation to be really sort of in a healing phase right now. And that's exactly what we find. So here is the rate of inflation. Again, when does it reach its high point? June 2022. And then it begins to come down really consistently from there. The last inflation numbers from the Bureau of Labor Statistics, you were looking at 3%. Okay, so down from a high of about 7 and change, we're down to 3, and we're definitely feeling the cooling off of the inflation. And so this, to any eye, looks like a nice unwinding of this problem. There's no visible crash. There's just sort of a steady releasing of the steam and the situation beginning to level off and stabilize. So this is really an ideal situation. And this is something that accounts for a lot of the strength of the economy, is the ability of the US economy to sort of vent this inflation in a stable way. So again, I want to draw your attention to the synchronization of all of these different data series. If you put up housing prices or rents or inflation, raw materials, any of these different indicators, and you kind of try to figure out, okay, when did it reach its maximum heat and then begin to cool off? Every single one of these indicators, every single one of these data series is going to point to June 2022 as kind of the turning point. And really since then, and I want to point out, now we've got a full year plus behind us from June of 2022. We've had a solid and stable phase of cooling and health in the economy. So this is really a point of optimism, and there's definitely reasons to feel very confident in the ability of the economy to sort of stably come down from those high points. So the other thing that I want to point out, and this is partially why the economy has been so durable. Remember, we talked about wage increases, okay? Wage increases have been very high for several years now, in Idaho particularly so. So we're talking about wages and incomes increasing 6 to 8% annually over the last few years. Well, what does that do? In the broader sense, what that does is it allows consumers to cope with inflation much better than they would otherwise. Now, we don't want to pretend that inflation is not a problem just because wage growth is high, right? Obviously, we would like prices to be stable, and that's why the Federal Reserve is trying to bring them down. But because wage growth has been so high, inflation has not caused any sort of catastrophe for the American consumer. And I want to show you what that looks like. So this is what we call real personal consumption. Okay, so this is essentially consumer spending adjusted for the inflation level. Now you see that big dip in 2020, right? That's the pandemic. That's people canceling vacations, putting off big purchases, kind of putting the economy on hold for a while, putting a lot of these purchases aside. But as we come out of the recession, out of the pandemic, this spikes back up to a healthy level. And look at what we have here with the spending level, right? So even adjusted for inflation, the consumer is still spending at a solid pace of growth, okay? This is rather unusual. Normally, if you have a high rate of inflation, you would expect people's spending to be really disrupted, right? They're not able to afford things. They kind of go into, you could almost think of it as like a financial bunker mode where you're just really trying to save, and this causes a decline in spending, and it can trigger a recession, right? This time around, the consumer's really in pretty healthy shape. And this is for twofold reasons. One, it's because they had all those savings from the pandemic, but it's also because wages have been rising. Okay, so the interesting thing is that even with prices up, 20% or even more, depending on what kind of product you're looking at, household incomes are up by a pretty similar scale, okay? So this inflation didn't really hurt the American consumer in the same way that you would normally expect, simply because wages were rising so quickly. Now, we want to make a couple notes here, right? Because the thing about inflation is that it has inequitable effects, right? So for example, if you are retired, your income is probably not rising at all. Okay, so retirees, for example, tend to be hurt fairly severely by inflation compared to people that are working and are still able to make wage gains, right? So we don't want to minimize inflation or pretend that it's not a problem. We just want to note that because wages have been rising so quickly, most American households have been able to cope with inflation better than expected. And this is a major reason why inflation has not caused a recession the way a lot of people feared. Okay, so let's pivot and talk about the other aspect of the labor market, of the economy, which is the labor market, right? So we had this story about mass layoffs, right? And it kind of raised particular attention because a lot of the layoffs that you saw in the news were from what we would kind of call headline tech companies, right? These tend to be some of the most famous and dynamic companies in the American economy, companies like Microsoft and Facebook and Apple, et cetera. Okay, so start of the year, when you see headlines about IBM and Microsoft having mass layoffs, you think, okay, well, if companies like that are starting layoffs, maybe that's really the canary in the coal mine and they're ahead of the curve and we're headed for labor market turmoil. But here's what we have observed, okay? The American labor market was so strong, and the Idaho labor market in particular was so strong that you could have layoffs. You could have maybe some growth shaved off without ever noticing it. Okay, so let me show you what that looks like. Okay, so this is the number of unfilled jobs in the United States. Okay, so these are vacancies, total job openings that cannot be filled. Okay, and so what you notice is that there's this big spike after the pandemic. So before COVID, this series, would probably average somewhere between 4 and 6 million a year. After COVID, it spikes to almost 12 million. Okay, so we clearly have this excessive level of unfilled jobs. These are jobs that we simply can't fill due to labor shortages. So let's kind of think about this. If you have 12 million unfilled jobs, okay, and you have layoffs, even layoffs that on paper are pretty big. So let's say X tech company, fill in the blank, lays off 40, 50,000 people. On paper, that seems like a huge number of people to be laid off. But when you have such a huge scale of unfilled jobs, the labor market is able to absorb them almost instantly. Okay, so you have layoffs without actually spiking the unemployment rate because people go back to work almost instantly in this labor market. So kind of the way to think about this is the labor market was so strong. I'm going to show you Idaho in a minute. Idaho looks very similar. The labor market was so strong that we had this cushion. We had all this slack. And so even some sector specific layoffs didn't do anything to rock this boat in a structural way because the market could just absorb them instantly. Okay, and so that ends up being the story that we see. So you can see stories in the news about mass layoffs, and you can really start to generate a picture of concern. But when you look at unemployment claims, when you look at the unemployment rate, you don't see any structural weakness in the labor market because it just absorbs people instantaneously. Okay, so let's go ahead and look at Idaho. The shape of the graph is very similar. Once again, we see that unfilled jobs in Idaho are almost twice, right, the pre-pandemic baseline. Okay, so there's structural strength in the labor market here that's so significant that even sector-specific layoffs are really not going to do anything to rock this boat. Okay. And additionally, let's just point out, tech in Idaho is going the opposite direction, right? Because of the CHIPS Act and semiconductor production. So this is just a robust, very healthy labor market. And none of those layoffs that were in the news had any capacity to shake this in any meaningful way, right? So just to kind of flesh this out a little bit, there's a data series that we like to look at from the conference board where they look at the number of job postings online, right? And they try to generate an index that sort of measures overall how tight is the labor market, right? So coming into the middle of last year, Idaho's tightness index, basically how in demand is labor, was over 200. And the way you read that is 100 means sort of like a normal equilibrium labor market. Okay, so in other words, you would say Idaho's labor market was more than twice as tight in terms of the demand for labor as in normal healthy conditions. So when you have that much extra cushion, you can actually shave a lot off before you ever have any weakness in the labor market, right? You have so much cushion that you can absorb any economic turmoil with ease. Okay, so let me show you what this looks like, okay? And this is sort of the headline picture of Idaho's labor market, okay? This is a data series that we call non-farm jobs, and this is sort of our main barometer of the strength of the labor market. Okay, so this is total employment, excluding agriculture. That's just because farming tends to be seasonal, and you don't want to mistake winter for a recession, essentially. So what do we see here? Okay, that red line is COVID. That doesn't look very good, right? So you're talking about 1 out of 11 Idahoans losing their job in 1 month. That was pretty traumatic. But even for something that traumatic, our recovery was remarkably fast. And here's what I want to draw your attention to. If you ignore the pandemic here and just try to draw a straight line, you will see that Idaho's labor market not only recovered fully from the pandemic, but we returned completely to our growth path. Okay, and this is maybe the most remarkable little bit of trivia of all when you look at this. Even after the enormous layoffs of COVID, Idaho's labor market beat its projections for that period. Okay, so we create projections of labor market growth, so at the beginning of 2020, we have a projection that says, what do we think employment is going to look like in 2022 or 2023? Okay, and even after COVID, Idaho is slightly ahead of those projections. So the ability of an economy to absorb 1 out of 11 jobs vanishing in a month, right? It's this shocking economic blow. The ability to absorb that, bounce back almost instantly, and within a year be running ahead of your projections is really astonishing. And I think that sometimes we take this for granted because Idaho is routinely #1 or #2 in the state for job creation. It's always one of the top states for population growth. Growth has become our norm, and so it can become sort of blasé and boring to talk about Idaho's level of growth. But the ability of Idaho's labor market to absorb the hit of the pandemic, come roaring back and be ahead of projections within a year or two is really astonishing, and we shouldn't discount this. So ultimately, when we look at the strength of the labor market, we can kind of condense it to this. Okay, what's the ratio of hires to layoffs? Okay, and consistently over the last several years, the number of people being hired in Idaho has been 4 or 5 times the number of people that are laid off at any given point in time. Okay, so pretty fundamentally, this is a robust labor market that has the ability to absorb any layoffs that have yet been thrown this direction. Okay, so when you see those headlines about layoffs, that for obvious reasons can be concerning. But the overall strength of the labor market nationally, but in particular in Idaho, is so enormous that these layoffs get absolutely dwarfed by the demand for workers and the hiring activity. Okay, so fundamentally, this is a remarkably strong labor market. It's a remarkably strong economy in Idaho. And all of those concerns that we had at the beginning of the year really seem to be evaporating as we speak, and we are left with a structurally strong and durable economy. So let's just kind of recap this and try to put a nice optimistic conclusion on this, and then we will transition to the Q&A for the remaining quarter of the hour. So fundamentally, this is a story about an economy that had cushion, right? We had margin of error, in other words, because first off, the pandemic savings and the high wage growth gave consumers kind of a cushion to deal with inflation. Inflation is still unpleasant. It's still economically destabilizing, which is why they're trying to bring it down. But we had the strength, the financial strength, to weather this sort of inflationary storm and come out with consumers really still in a pretty healthy situation. And ultimately, when we say consumers, of course, we're talking about American families, American households. And so for them to be in a healthy financial situation is ultimately our objective here. And then secondly, we can say that the labor market was so strong, we had so much excess demand for workers that we were able to absorb all of those layoffs without destabilizing the economy. So even those stories about mass layoffs ultimately became sort of a statistical blip in an otherwise very strong labor market. So for all of these reasons, we feel that the story that has emerged is not one of economic turmoil, but of a very durable economy that has survived and thrived amid several really major blows. If you think about COVID and you think about the inflation that follows, that's a pretty serious mix of destabilizing factors, right? And yet here we are, running ahead of projections with the strongest year of income growth that we've ever recorded in Idaho. And so for all these reasons, we think that the future continues to be bright for this state. So let us transition to the Q&A.
All right, thank you, Sam. Again, if you have any questions for Sam, please use the Q&A button at the bottom. The first, actually, we just had a question. So Sam, you mentioned a Wall Street Journal article in your presentation. What was that article? And could you maybe provide a link to that?
Yeah, I don't remember the exact title. It was by their chief economics columnist, Greg Ip. It's Greg, and then his last name is just IP, is how it's spelled. So if you look at his archive, he had an article, something along the lines of what really caused inflation, essentially. He's just a columnist that I kind of personally like in general.
So then one is from one of your colleagues, which is what definition of inflation are you subscribe to?
So I care most about consumer prices. There's different ways to look at inflation. You can look at from a currency aspect, the value of the currency on exchange markets. But I think that most of us agree that ultimately the most important question is, are American households able to afford their expenses? So we want to look at the costs facing American families and consumers. So it's the consumer aspect of it that is the most important ultimately.
Right. You mentioned retirees being more affected. In what ways are seniors being left out of the strong economy? And who else is being overlooked or left behind in this condition?
Yeah, so when you have an economic climate where both wages and prices are growing quickly, the people that are wage earners, that are employed, are going to be able to cope with inflation better than people on fixed incomes who are living on savings. So retirees obviously end up being the most affected simply because their primary income streams are going to be Social Security, personal savings, things like that are just not going to keep up with inflation. So wage earners, people that are currently employed, their level of income is going to be fairly stable on an inflation adjusted basis. And we saw that just in the fact that consumer spending is pretty stable. But retirees are just going to be left out of that simply because their streams of income won't keep up. And then there will be inequities in the economy in terms of some sectors having faster wage growth than others. Right, so that's the main effect of inflation. Inflation is redistributive because some people will have faster wage gains than others. So it sort of redistributes what people's incomes look like in real terms.
What was there a sector that had higher wage gains than another, like in terms of industry sector or employment sector?
So right now what we're seeing is it's not necessarily industry sector so much as we're seeing something called wage compression. Okay, and this occurs when you have, so let's just kind of think of a hypothetical. You have an employer that is really trying to hire for, well, let's just say a machinist position or something like that. So what they do is they have to keep raising the wage that they're offering to attract people. So as a result, what happens is people that are moving jobs can get faster wage increases than people who stay in their existing jobs. So you can end up with new offers to new employees sometimes being as high or higher than people that have been with the company for existing periods of time. So we call that wage compression. And it's basically when the labor market gets a little bit distorted by the fact that you have to keep offering higher and higher wages to attract workers.
In your explanation of the labor shortage and how the pandemic and their relationship, it's kind of a common question. It seems strange that the population in Idaho is increasing at the same time we are having a labor shortage. What would you care to respond to that?
Yeah, so the main thing driving that is just the fact that a lot of the population growth in Idaho is people over the age of 65. So the main thing driving the labor shortage in the United States right now is retirements. Labor force participation has actually recovered for a lot of the younger demographics, but we had a wave of retirements during COVID. So before COVID, retirements in the United States averaged 1 to 1.2 million per year. And in 2020, we had almost 5 million retirements. So a lot of people decided to take their retirement during the pandemic, just for obvious reasons. And so this accelerated the retirement of the baby boomers and has created a labor shortage. So a lot of it is just demographic and the aging of the population.
However, when you say that the population increase has also helped bring in working age population as well, so that's kind of helping to fuel the growth.
It has, but a lot of the growth is still retirees. So it's a balance that doesn't necessarily go all the way to healing the labor shortage in Idaho.
That makes sense. Is there anything that you would recommend keeping an eye on? As you know, it's a lot of uncertainties still, even though we're talking about how we're looking at soft landing, those types of things, there's still some fairly big uncertainties out there, such as election, debt ceiling, these types of things. How would those impact the local economy?
Yeah, I mean, the economy is a very complicated organic organism. And so I like to accustom or compare the economy to the human body, right? Because we have a lot of parts, and only one of those has to be malfunctioning for us to become ill, right? So if you have, you know, a cold or a cough or pneumonia, you're not going to go, well, you know, my liver's really healthy, so I'm fine and I don't feel the effects of this, right? Only one thing has to go wrong for the entire thing to begin to kind of fail in a sense. And the economy's like that, right? There's contagion. And so there are always risks to the economy. And we don't want to say that the economy is invulnerable. That's not the message, right? The message is that it's been able to deal with shocks really well so far. So there are, of course, causes for concern. So housing is still remains unaffordable for a lot of people, and that's sort of Damocles hanging over people's head. Credit card debt is pretty high right now, so that could be considered something to keep an eye on, sort of a red flag of consumer finances. There are always things that we could point to that are maybe red flags, but the overall point has been that the economy has been really durable so far, and even with big shocks from COVID and inflation, the labor market here in Idaho and the health of households continues to be really strong.
And do you think corporate profits have been affecting inflation at all?
So corporate profits are fairly high right now. This is actually a data series that you can look at. If you go to the Federal Reserve data site, you can look at corporate profits. They're fairly high right now. And so that can be exacerbative. But certainly with what we saw in raw material and wage increases, we would consider those the primary triggers of inflation.
And then how do you see, what do you see the impact on higher education participation in Idaho with the current and future economy?
So there's a pretty strong relationship that we observe that enrollment in training and education is higher when the economy is suffering, when there's a recession and high unemployment. And that makes sense, right? Because if you are laid off, if the labor market is weak, you figure this is the time to, instead of waiting out the recession, go do something productive and enroll in training. So that tends to be the relationship, that enrollment in retraining programs and education is higher when the economy is weaker. Okay, so those are inversely correlated.
Then with there's some federal government programs that will be ending with the state or the federal fiscal year, like repayment for student loans, less support for SNAP, those types of things. Do you feel those elements may impact Idaho's economic health and some of the resiliency you're seeing that you've been talking about?
Yeah, so I actually was looking at this data yesterday. Idaho's level, the percentage of Idaho households that receive benefits from programs like SNAP, welfare cash payments, et cetera, those have gone down over time. Okay, so we saw a spike during the pandemic, obviously, but the level of participation in those programs in Idaho has been coming down over time. So we would say that Idaho's exposure to these programs is decreased, and therefore the economic leverage that they have over Idaho's economy has decreased. We've seen falling participation over time.
And as wage growth continues and labor, as wage growth due to a continued labor shortage continues, do you see that working against inflation coming down?
Yeah, wage pass through, probably going forward, this is going to be the major contributor to inflation, because like I showed you, the price of raw materials has actually been declining for the last 6 months. So the wage growth at this point is one of the stronger contributors to the inflation puzzle.
And then explain, if you can, on the macroeconomic side, inflation's up 2 to 6%, but goods are up 20 to 30%. What's the difference between those two kind of rates of change?
Yeah, so that's because inflation is compounding, and we've had 3 solid years of inflation at this point. So if you have, a year of 6 and then a year of 8, and then you have another year of, it comes back down to 6 and then down to 3, this compounds over time, right? So overall prices are up 20% since 2019, which at this point is, 4 years ago. So that's the difference between the annualized rate of inflation and the compound growth of prices over time.
And then I think the final question is, so in your discussion of Idaho, how unique is this, and how do we compare to other states? Who are other states that are kind of in a similar situation? I mean, the federal government just released its, for the nation, the unemployment rate last Friday, and just so you know, Idaho's won't release until next Friday on the 18th. But for July, it was 3.5%. So that's very low unemployment for the nation. Seems like this is kind of a national type of phenomena in terms of the labor market and the recession. How does, I mean, you kind of talked about it a little bit, but how does Idaho, how is Idaho set apart in this kind of national trend, I guess?
So Idaho is one of a fairly narrow club of high growth states right now. And you have a couple, you can even draw them on the map. You have a couple bands of high growth. One is the lower Atlantic seaboard. So the Carolinas, Florida, Georgia, Texas, and then what we'll just call the Intermountain West. So this strip of Idaho, Utah, Arizona's had pretty good growth. So Idaho is solidly in these sort of strips of high growth states that are growing on a population basis, absorbing population from shrinking areas like the Midwest, the Northeast, some of California's big metro areas. So Idaho is a growth state, and we're consistently one of the top performing states for labor market and population growth. And really the only state that has a roughly similar profile to us is our neighbor to the south of Utah, just with this really strong growth in the Intermountain West. So the labor market is strong nationally, but Idaho is in another tier of labor market strength, with top of the charts growth and an unemployment rate that recently, has been below 3% pretty consistently.
Our next webinar is scheduled for September 6th. Our Eastern Idaho labor economists, Matt Paskash and Ryan Whiteside, will be focusing on veterans as the topic. And we'd also like to remind you that the Idaho Department of Labor has many services geared toward job seekers and employers, but it also includes free access to labor market information that you can get at lmi.idaho.gov. There you can find a variety of dashboards, as well as a page dedicated to regional information that you can find the labor economist in your area if you have any questions and you want to find out more about some of the things that Sam was talking about, or any other kind of things you might want.